we deal with FIFO, first in, first out, we see we had a beginning inventory of 100 units. On April 10th, we purchased 1,000 units at $10 a unit. Then we also had 80 units at $11 a unit. Then on the 18th, we sold 90 units. So we can show that we sold those 90 units from our beginning inventory. And then from there, let me see here what I'm saying wrong here. Sale of first in, first out, perpetual. Okay, so basically in the perpetual method, we're going to constantly keep track of our inventory. So we will show the sale of 90 units based on the $10 a unit. And it shows that we have left 10 units from our beginning inventory, and then we have 80 units from the purchase on April 10th. So I was wrong there. The April 10th purchase was of just 80 units at $11, and what they're doing here is carrying forward the beginning inventory so we can always have an accurate description of what our costs are. So we see what we have left in our inventory on April 10th. We've got 10 units left at $10 a unit. We have 80 units left at $11 a unit. So then when we go and sell 90 units on April 18th, we're going to basically get rid of the rest of our inventory. We've got 10 units from that initial beginning inventory and then our 80 units from our April 10th purchase. So then from there, on April 20th, we purchase 70 units at $12 a unit. So we add that to our inventory balance. And then on April 27th, when we sell 50 units, we will show that we sell 10 units at $10 a unit, and then we would sell our 40 units at the $11 a unit. So it allows us to constantly see what we have sold, and it will also allow us to keep track of our ending inventory at the end of the period. When we're dealing with average cost, we're going to create a weighted average of those costs. Date our average. So in this scenario, if we start with 100 units at $10 a unit, we have a balance of 1,000, and then we purchased 80 units at $11 a unit, we keep a moving average where right now we have 180 units available, and we take that cost of $1,880 divided by 180 units to come up with our moving average. So when we sell 90 units, we'll show the cost is going to be at $10.44 per unit. So we'll show that sale, and then from there we will be able to show what we have remaining, and then we'll continue to update that as we purchase 70 more units at $12 a unit. We've got our moving average for those 90 units that are still on hand at $10.44. And then we add those 70 units at $12 a unit. So now we've got a total of $1,780. And at 160 units, we will update our price per unit. So again, when we sell those 50 units, we will show that cost based on our new weighted moving average. Now, there's another method out there called LIFO. LIFO is when we take the last items to be the first out. When we're dealing with periodic, remember we're not going to count our ending inventory until the end of the period. So under LIFO, we are going to show the newest costs to be the first that were sold, and then the oldest cost or the earliest cost will be in our ending inventory. So under LIFO periodic, we're going to show our units, and we'll show that's the amount that sits in our ending inventory because the ending inventory will have the newer units because what we sell will be the in our ending inventory, we're going to have the oldest units, the ones that were the earliest, and in our cost of goods sold, we'll have the most current costs. When we're dealing with perpetual, we will have to keep a running total because, again, we start with so much inventory, and then as you see here on April 10th, we purchased 80 units. So under LIFO and the perpetual, when we have a sale for 90 units, we're going to take and show into cost of goods sold the most current purchase of the 80 units, and then we'll take the 10 units at $10 a unit from our beginning inventory. So then we'll have left over our 90 units at $10 a unit from our beginning inventory. We purchased another 70 units at $12 a unit. And then on April 27th, when we sell 50 units, we'll take that from the 70 units we just purchased to show the cost of goods sold. And then our ending inventory, as we can see here, is going to be continued. It will always be updated after the end of each sale. Now, why does any of this matter? Well, it matters because based on the method we use and based on inflation or rising prices, certain methods will come out with a lower net income versus a higher net income. So as you look here on our various flow assumptions, when we're dealing with FIFO, we've got either periodic or perpetual. We're going to end up with the same cost of goods sold, same cost available for sale, same ending inventory, and our gross profit is generally going to be higher than our LIFO because under our LIFO method, we're taking the most current items that we've purchased to be shown in cost of goods sold. So that generally ends up with a higher cost of goods sold and ultimately with a lower net income. So as you can see here, our FIFO method shows a higher gross profit. Our LIFO method is going to show a lower gross profit. And then our weighted averages are going to be somewhere in the middle of the two of them. So FIFO is going to show the lowest cost of goods sold when we're dealing with rising prices. And then as a result, FIFO is going to show a greater inventory on the balance sheet. LIFO is going to deal with higher costs being in the cost of goods sold and the lower amounts being in the inventory. The average cost method is going to be somewhere in between the FIFO and the LIFO. As you can see, this sheet, this shows the various disclosures they have in their financial statements, and they basically explain what method they're using and the specifics as it relates to helping to understand in greater detail the inventory on their books. Now, when we're dealing with Starbucks, they're asking here, what is the primary cost flow? As we saw on the disclosures, they're using a moving average. If prices of goods are based on an average of the goods available, then this assumption produces amounts for ending inventory and cost of goods that flow in the middle of LIFO or FIFO. What type of system does Starbucks use? They use a perpetual system. And we would know it's a perpetual system because of the moving average. Moving averages can only happen in a perpetual system. Now, their purchase commitments, as we talked about earlier, will not be included in their inventory. They are disclosed in the financial statements. Okay, so as we move on, we want to talk about various cost flow assumptions and what those consequences are. So ultimately, we want the balance sheet, as it states here, to be a faithful representation of the inventory valuation. But the reality is you got to come up with a method because there's no simple answer as to how to determine it. As you can see in your chapter, most people do use that FIFO method. As we deal with using LIFO, well, the benefit of LIFO is that those replacement costs versus our most recent purchases are going to line up fairly accurately. What's the income tax effect? Well, if we use LIFO, we're going to have a lower net income and ultimately lower income taxes when we have rising prices. But when we use FIFO, there's going to be a higher net income and higher income taxes. So ultimately, once they start with a method, they need to continue with that method. But a lot of times with public companies, FIFO would be possibly the more desirable because of their financial statements being desirable. I'm not going to talk about liquidation of LIFO layers. We're not going to cover that. But basically, as far as earnings management goes, sometimes LIFO liquidation happens because management wants to increase their income. That's the only thing I want you to know about that. Okay, so we know that when we're dealing with LIFO and we're dealing with rising prices, the beginning or the ending inventory will show a lower amount than using the FIFO method. They need to continue using the same method so we can compare one period to the next period. As you see here, significantly large amount of people use the FIFO method. As we see here, 26% use the LIFO method. How do they choose? If a company opts to use LIFO, they must use it for income tax purposes. And of course, that creates a better benefit from a tax standpoint. It doesn't always produce lower taxes. That's in the case of rising prices. If costs are going to fall, then FIFO would be the one that would produce lower taxes. So, various reasons. Stock price is a significant reason as to why they would choose the method they use. Tax considerations could be others. I'm not going to spend time on dollar value LIFO either. And I'm not going to worry about the cost indexes. As you can see, I really want to cover those items that are of importance related to this chapter. So I will take the next PowerPoint and we will go over some of the problems.